Adverse selection. Adverse selection and moral hazard are economic concepts that apply when some customers can inflict higher costs on the producer of a good or service, and the customer has more information about the factors related to those costs than does the manufacturer. Adverse selection applies to situations where the buyer knows whether he or she is a high quality buyer or a low quality buyer, but the seller does not. That is, the customer knows whether he or she is a low cost or a high cost customer. Here's an example. Someone who wants to buy auto insurance. The buyer knows if they're accident prone or not. The seller of insurance may not. But who is more likely to want insurance? The accident-prone people. So the very people who are most likely to want the product are the ones who are most expensive to supply it to. What if you just decided, okay, well, we'll charge those people higher premiums? Then only the really, really accident-prone people will buy. If you can't identify who is the high cost person and who is the low cost person, you're not going to get out of your problem by just charging a higher premium. And what about a person who has just learned that they're sick? They're probably more likely to want to buy health insurance. Another example of adverse selection outside the insurance market is credit cards. Let's say you get a notice in the mail for a credit card charging a 22% interest rate. That's a really high interest rate. What kind of people are likely to want to borrow at these rates? Well, it's the people who believe that they're not going to be able to pay it off. So people self-select into what kind of credit card they have. Okay, so that's the problem with adverse selection, that sometimes the people who are more likely to want to buy your product are the people it's most expensive to serve. So how does the insurance market deal with this problem, with the fact that the supplier doesn't know which of those people are the high cost people and which are the low cost people? Well, one thing insurance companies do is they have applicants fill out lengthy forms. For example, to get health insurance, you have to list many aspects of your health condition, your doctor's diagnoses, any medications you're on, etc. If you leave anything out or there's anything inaccurate in the form, that invalidates the policy. Another way that insurance companies can try to deal with adverse selection is to make sure that the buyer can't get a payout from insurance for a period after purchase. So, for example, if you have a life insurance policy that no one can collect on until 6 months after the policy is purchased, that means that a person who unfortunately has just received a diagnosis that they're terminally ill won't be able to come in, buy your life insurance policy, and then get a quick payoff. That would be someone that, by adverse selection, would be more likely to want to buy life insurance. But by delaying the payment, you know that that high cost individual isn't going to come in and buy insurance from you. And finally, once again, we have a form of signaling behavior, a way for low cost customers to identify that they're low cost and separate themselves from high cost customers. The way insurance companies get their customers to signal how costly they are is to offer health or auto insurance contracts that only a low risk person would accept. That is probably a high deductible contract. Someone who believes they're going to have to file claims isn't going to want to have a high deductible contract because that will make it harder to get money back when they have those inevitable accidents. But someone who's a good, safe driver or in good health would accept a policy with a high deductible because that means that They don't think that they're likely to collect in the near future, so they're willing to accept a contract where they won't get as much back as quickly. Sometimes the existence of adverse selection inhibits the growth or creation of markets. Here's another example from the insurance market. There's a big market for auto insurance because insurance companies, despite the information asymmetries, do have ways of figuring out who the bad drivers are. They can look at age. If someone's very elderly, they may have vision problems. They can look at driving records, etc. But there's not a big market for long-term healthcare insurance, the kind of insurance you might want to get if you think that in the future you might end up in a nursing home and you want to help in covering those costs. The people who buy it are the ones who are most likely to need it. They probably don't have family support or don't get along with the families they've got. So they know they're probably going to need some sort of assisted living environment, which will be expensive, so they'll need to file a claim. But that's the kind of information that insurance companies can't get from any kind of driving record or other record about your life. So it's really hard to tell who those people are. As a consequence, there isn't a very big market for long-term healthcare insurance. Insurance companies just don't want to offer it.